Listen, we need to talk about something that just changed with your Social Security check. Changed as of right now. A lot of people treat Social Security like it's a fixed, dependable number in the budget, like it never moves. But the truth is, the program is always changing, and those changes can hit your wallet, whether you notice them or not. And starting January 1st, there were 6 major rule changes that can affect your money in real, practical ways. Pause. Some of these sound like good news on the surface, until you look at what's happening behind the scenes. So let's go through it clearly, and let's go through it straight. First, your benefits went up by 2.8%. Now, for the average retiree, that's about $56 more per month. Sounds nice, right? Pause. But hold on, because at the same time, Medicare Part B premiums jumped nearly 10%. They went from about 185 I to about 202 down 90 WAC. And what that means is simple. A big chunk of that cost of living increase you just got can walk right back out the door to pay Medicare before you ever feel the difference. That's the part people don't like to say out loud, and it doesn't stop there. Second, if you're working while collecting benefits, the earnings limits they're shifted. If you haven't reached full retirement age, you can now earn up to $24,480 before benefits start getting reduced. That's higher than last year, but you still need to understand the rule. For every 2 years you earn over that limit, Social Security can withhold 1 day in benefits. Now, if you're reaching full retirement age this year, the earnings limit is much higher, around $65,160, and the withholding rule is different. They take 1 hawan for every 3 hours you earn over the limit, and the moment you hit full retirement age, pause. The earnings test disappears. You could earn $10,000 a month. You could earn $1 million a year. There's no withholding at that point. Third, for those born in 1960 or later, full retirement age is officially reaching 67. And that shift completes the long climb that's been going on for decades. So if you're in that group, you need to pay attention because it affects your claiming strategy in a very big way. And here's the part that stings for a lot of people. If you claim early at age 62 pass, you can face about a 30% permanent reduction in your monthly benefit. Permanent means permanent, not for a year, not until things get better. It follows you for the rest of your life, and it affects survivor benefits too in many cases. That's why you don't want to make a fear-based decision. You want to make an informed decision. Now let me talk to you straight about what this really means for retirement, because I've watched this pattern repeat year after year. People get excited about a COLA increase. They hear your check is going up, and for a moment it feels like relief. And then reality shows up and takes a chunk of it back before you even cash the check. It's like someone putting an extra $20 in your wallet while picking your pocket for $15 at the same time. And no, this isn't an oops. This is how the system works. And if you don't understand the rules, you can get worked over without even realizing it. So let's break down the COLA increase in real numbers. Your Social Security benefit goes up about $56 per month on average. That's $672 a year in theory. But Medicare Part B premiums also rose. So many people don't actually feel the full increase. When Medicare goes up, your net deposit can shrink back down. And it's not just the premium. The Part B deductible increased too, up by about 26 US to around 283 US for the year. Pause. So even if your check goes up, your healthcare costs can rise faster. This is what I call the retirement trap. You get the raise, but the costs you can't avoid rise right alongside it. And here's what makes people angry. This is the 3rd straight year where Medicare Part B premiums have risen faster than the Social Security cost of living adjustment. Think about what that means. The adjustment designed to help you keep up with rising costs isn't keeping up with one of the biggest costs retirees actually face. So the government gives you an increase with one hand, and take some of it back with the other. And a lot of older adults already know this feeling. Surveys have shown that many seniors believe a 3% COLA wouldn't be enough to keep up with rising prices. And if that's true, then 2.8% is even tighter. Now let's talk about full retirement age again, because this is where many people make the biggest mistake. If you were born in 1960 or later, full retirement age is 67. That means if you want your full benefit amount, you're waiting longer than people used to. And if you claim at 62, yes, you get checks sooner, but you lock in that reduction. So this becomes a balancing act. Your health, your job situation, your savings, your family needs, your life expectancy, and your budget. No two people have the exact same answer, but the numbers matter and the rules matter. Now, let's return to the earnings test because it's one of the most misunderstood rules in the whole system. If you're under full retirement age and you earn over $24,180, benefits can be reduced. People hear that and panic. But here's the part many don't understand. Benefits withheld due to the earnings test aren't necessarily lost forever. Social Security can recalculate your benefit at full retirement age and give you credit for months when benefits were withheld. But, and this is a big but, getting money later is not the same as having it now. Time value matters. Inflation matters. Your bills don't wait. So you still want to plan this carefully. Now here's some actually good news for a change. Fourth, there's a new $6,000 tax deduction for people after 65 and older that can reduce taxable income. And it's available whether you itemize or take the standard deduction. That's important because most retirees take the standard deduction. But listen closely, because the details matter. If you're a single filer with modified adjusted gross income up to around $75,000, or married filing jointly up to around $150,000, you can qualify for the full $6,000 deduction. If you're married and both spouses qualify, that's potentially $12,000 total now Johns. And this is on top of the regular standard deduction and the existing extra deduction seniors already get. In some cases, combined totals can reach around 23,150 AMs for single filers age 65 plus and up to around 46,700 AM for married couples, depending on how the rules apply. Now here's the catch, because there's always a catch. Pause. This deduction phases out above those income levels, reducing by about 6 cents for every dollar over the threshold, and it's temporary, running through the 2028 tax year, and unless Congress extends it. So you've got a limited window here. That means if you have flexibility in how and when you recognize income, things like Roth conversions, selling investments, timing withdrawals, these next few years could be a strategic opportunity. And to put real dollars on it, if you're in the 12% tax bracket, a $6,000 deduction could save about the $720 in federal taxes. If you're in the 22% bracket, yes, it could be about $1 through $320 on Osage. If both spouses qualify and you're getting $12,000 total, you can double those savings. That's not pocket change. That's groceries. That's utilities. That's a car repair. That's money you can keep. Fifth, the taxable maximum for Social Security also changed. In 2026, Social Security payroll tax applies to wages up to around $184,500, up from around $176,100. If you're an employee, you pay 6.2%, and your employer matches it. If you're self-employed, you pay the full 12.4%. Yourself. Income above that cap isn't taxed for Social Security purposes, and it also doesn't count toward calculating future benefits. And that matters because your Social Security benefit is based on your highest 35 years of earnings. If you're still working and earning more now than you did earlier in your career, you could be replacing lower earning years with higher earning years, which can increase your future benefit. Now, I want to address something most people don't realize about COLA itself. The cost of living adjustment is based on inflation measures designed around urban wage earners and clerical workers, not retirees. Retirees spend differently. Healthcare is a bigger slice of the pie. housing, prescriptions, out-of-pocket costs, these can rise faster than general inflation. So when seniors say the COLA doesn't match real life, that's not just complaining. That's reality for many households. And let's be honest about healthcare costs, because this is where retirees are getting squeezed hard. It's been estimated that a person retiring in 2025 could need over $172,000 saved just to cover healthcare costs in retirement, and that figure doesn't even include long-term care. At the same time, reports have shown the purchasing power of Social Security has dropped significantly over the years, meaning your dollars don't go as far as they used to. So when people wonder why retirees feel like they're falling behind, even when their checks go up, this is why. It's the slow squeeze. Your groceries go up, utilities go up, insurance goes up, property taxes go up, prescriptions go up, and your Social Security adjustment might be helping, but it may not be keeping pace with the full reality of your expenses. Now, here's what breaks my heart. People are making major retirement decisions based on fear instead of information. Some claim at 62 because they're scared Social Security won't be there later, even though claiming early locks in that permanent reduction. Some avoid part-time work they'd actually enjoy because they're terrified of the earnings test, not realizing the rules change once they hit full retirement age. And many people miss tax opportunities like this new deduction simply because nobody told them it exists, or they assume it's too complicated. But knowledge is power in retirement planning, and ignorance costs real money, month after month, sometimes for the rest of your life. So let me give you an example of how this plays out. Imagine someone under full retirement age earns $30,000 while collecting Social Security. The limit is $24,480. That means they're $5,520 over the limit. Social Security withholds $1 for every $2 over, so that could be around $2,860 in benefits withheld that year. If they didn't plan for it, that can wreck a budget. And the sad part is, many people could avoid the worst outcomes by understanding the rules ahead of time. Timing income, timing the claim, planning around Medicare costs, and using tax breaks when they're available. Here's the bottom line, and I need you to hear this clearly. Social Security is not set it and forget it. The rules are not intuitive. The annual changes matter. Medicare premiums matter. Earnings limits matter. Taxes matter. The age you claim matters. And these decisions echo through the rest of your retirement. That average $56 monthly increase, once higher Medicare costs take their bite and inflation takes its bite and everyday expenses climb, many people will feel like they're treading water at best. But if you understand the earnings limits, if you plan around your full retirement age, if you use the tax deduction strategically, and if you treat these changes like something you actively manage, not something you just accept, you can potentially add thousands of dollars a year to your real spendable income. This isn't about being pessimistic. This is about being prepared. Because at the end of the day, this is your retirement, your money, and your future. Don't leave it to chance when you can understand the system and make it work for you.